This is Nightly Business Report.
Happy New Year, everyone, and welcome to this special holiday edition of Nightly Business Report. I'm Tyler Matheson. 2015 is here. For many, it's a time filled with resolutions. For investors, perhaps even some financial resolutions. And the best way to fulfill those promises we all make to ourselves is to focus on the year ahead, starting now. Tonight, we will bring you the outlook for 2015. Our reporters will highlight the key things to watch in some of the biggest areas in business, from the economy to energy and, of course, to the stock market, and that is where we begin. Well, some say 2014 was a turning point for the economy and the job market. They both saw solid gains, and the growth engine shifted into a higher gear. Part of that was driven by lower energy prices, which puts more money in the hands of consumers. And both the economy and energy had a big impact on the stock market. So what's in store for the next 12 months? Jackie DeAngelis reports on energy. Bob Bazzani looks ahead at the stock market. But first, Steve Leisman on his outlook for the economy.
2015 will be a year with big central banks around the world pulling in opposite directions. But hopefully their economies all going the same way, that is, up.
The U.S. Federal Reserve looks likely to hike interest rates.
It will be the first rate hike in just about 9 years, and look for it around the summer. But the Fed won't be aggressive about raising rates. The Fed funds rate could end the year just around 1% from the current level of 0.
Look for the European Central Bank to launch an outright quantitative easing program where it buys sovereign bonds.
This should help at least stabilize the Eurozone economies, if not even propel some growth. And the Bank of Japan should stay the course with its wide-open monetary policy. As for growth in the U.S., the positive effects of lower oil prices should offset the marginally negative effects of higher rates, and then some.
Wage growth should finally come.
And what will be one of the biggest stories in 2015? Wages should begin rising meaningfully, and the middle class will finally begin to feel the positive effects of the post-crisis recovery.
Energy prices began a wild ride in 2014. Increased North American supply coupled with waning global demand pushed prices of domestic and international crude significantly under $100 a barrel. Here are 3 predictions in energy for 2015. First, oil prices will bottom around $50. With the U.S. producing more than 9 million barrels of crude per day and OPEC putting out 30 million, prices will continue to decline in 2015, and producers will sacrifice margins to hold on to market share. Low oil prices will take some time to trickle into the economy, but they will give markets a boost, and that will spur demand, which will then help prices rebound. Second, OPEC will lose influence. Within the first half of the year, OPEC will be forced to cut production to help stabilize the market. Key member Saudi Arabia has more flexibility on pricing than other members like Venezuela and Ecuador, but as more supply comes out of the U.S., OPEC's influence on the global market will diminish. Third, stocks of U.S. producers will see some volatility. In an environment where prices move lower, producers like Exxon, Chevron, and Hess will continue to feel pain. They'll manage costs in the face of declining prices, but those efforts won't be recognized by investors. After oil bottoms and begins to rebound, energy stocks will be loved again.
Russia will be an even bigger problem next year, though Europe will surprise and Google gets serious in its fight with Apple. Here are 3 predictions for 2015. Boring, they're not. First, Russia defaults on its debt. The Russian ruble has hit new lows against the dollar. Oil has dropped 40%. Crude oil and petroleum products are half of Russia's export revenues. How will they pay for imports? They will default on their debt. Second, the European stock market outperforms the U.S. stock market. No recession next year in core Europe. The Eurozone is stuck in a long-term, slow and no-growth environment. But the core countries will not sink into a recession. The euro will remain weak, boosting trade. After a year when expectations were constantly revised downward, European corporate earnings will begin turning around. Deflation will remain an issue. Third, Google buys PayPal. PayPal is scheduled to be spun off from eBay sometime in 2015. It won't happen. Google will buy PayPal and combine it with Google Wallet to ward off Apple's Apple Pay.
Our 2 guests tonight say 2015 could be another happy new year for both the economy and stocks. Please welcome Josh Feinman. He's Chief Global Economist at Deutsche Asset Management. Art Hogan, Chief Market Strategist with Wunderlich Securities. Gentlemen, thank you for joining us, and Happy New Year to both of you. Josh, let me just begin with you. You heard Steve Leisman's thoughts about the economy. What is your outlook for U.S. economic growth next year, and what could make it either much better or much worse than your base case?
I'm pretty optimistic. I mean, I think that the economy can grow 3%, maybe a little bit more. That's kind of what we've been averaging, or a little bit better than we've been averaging over the last year and a half or so. I think there are two forces behind that. One is a lot of the post-bubble headwinds, so to speak, that were restraining the recovery early on: housing overhang, weak consumer balance sheets, credit restraint, government retrenchment. A lot of that stuff has faded. On the other is the decline in oil prices is giving a nice boost to household purchasing power. So those things, I think, can help us stay in this higher gear and maybe even shift a little bit higher.
All right, let me turn to Art and ask you if you agree with basically Josh's forecast that the backdrop for U.S. stocks will be pretty good.
Hey, Tyler, I think Josh has it exactly right. I think when you look at 2015, you're going to be looking at a time frame that you're going to have three significant tailwinds, and all of them positive for U.S. markets. I think first and foremost, we're having rising labor. So the more people working, the more money they have to spend. You've got lower energy prices, so you've got more discretionary spending power, and you've got the highest level of consumer confidence we've seen since 2007. So if you combine those things with a divergent monetary policy, meaning we'll start tightening in 2015, the rest of the world will continue to ease, will certainly continue to strengthen the dollar. A strong dollar is going to attract global capital into U.S. markets. So I think we've got significant tailwinds for the U.S. markets heading into 2015.
Josh, I don't want to be a downer on New Year's Day, but is there anything that you see on the horizon that could throw cold water on your forecast?
Sure, there are some risks. A lot of them are outside the U.S. We have sluggish growth in a lot of other parts of the world, and there's a chance that stays that way. Also, the stronger dollar has a negative impact on U.S. exporters. So the outlook for exporters is a little bit negative, and the oil price decline, while beneficial certainly to the economy as a whole, there are pockets of the economy that might not benefit from that, particularly the oil exploration sectors.
And Art, back to you. Let's talk your thoughts about where we might end the year with respect to the S&P 500. What kind of year is it likely to be, and what sectors are likely to outperform?
Well, Tyler, I think the S&P 500, and not in a straight line, but will certainly earn something like $127. And if you put a multiple on that, a historic multiple on that, you get to about 22.25. So you're talking about a market that could be up 9% on a year-to-date basis. Remember, you also get about a 1.4% dividend on that. So a very good return. I think the three drivers there, as we spoke to, are certainly going to be, the tailwinds in the economy, a higher level of employment, a consumer that's confident, lower energy prices. And I think the sectors you want to look at because of that would be consumer-facing. So anything that faces the consumer probably does very well. I think you want to look at technology. Technology, I think, is going to have a significant year. We're going to see a lot of M&A activity, and we're certainly going to see a lot of growth, earnings and revenue growth. And the third thing you want to think about is regional banks are going to do very well. We're going to start to see higher interest rates, and banks make more money in a higher interest rate environment. So, come the second half of the year, you're going to be looking at regional banks that do very, very well.
Quick thought on Europe, Art. You heard Bob Pisani say that his bet was that Europe's stocks would outperform ours. You agree?
Well, I'd love to see Europe do something both in monetary policy and something structurally. They've got a lot of structural changes. They can make a couple tweaks to the way they're running business over there that would be a significant benefit. And the multiples that Europe is trading at right now in 2015 are a lot lower than the United States, but they're for a reason. So Europe could have a very good year. They need to make a couple changes, though.
Josh, I didn't hear you mention interest rates as you talked about the economy in 2015. Do they not matter? I mean, we've heard about the Fed likely going to be patient in raising interest rates. What do you think the trajectory is likely to be, and will it dampen the economy and chill stock investors?
I don't think so. I mean, I think that, we just had a 6th anniversary of zero interest rates. I don't think we're going to have a 7th anniversary. I think that economic conditions will probably be such that the Fed begins to raise rates. I agree. But I think it's going to be a very shallow trajectory, not anything that would imperil the recovery. The last thing the Fed wants to do is take chances with the recovery. So, and with inflation still very low, I think it affords them latitude to be patient. So I don't see interest rates spoiling the party.
Right. Josh, thank you very much. And Art, thank you as well. Josh Feinman of Deutsche Asset and Art Hogan with Wunderlich. Happy New Year, guys.
Happy New Year.
The two sectors with the most influence on the stock market are technology and financials, and that's because they're the two heaviest weighted groups in the S&P 500, and both of them performed pretty well in 2014. But what are the key things to watch in the months ahead? Kayla Tausche with a look at the financial sector, but first, here's Josh Lipton on tech.
Consumers can never own enough gadgets, and tech companies will keep pushing their latest products to them in 2015, but not every tech toy will fly off the shelves. Here are 3 predictions. First, the crowded market for wearables will get smaller. Fitbit and Jawbone are now household names, and the launch of Apple Watch next year will make a big splash in the wearable space. But is there really enough demand for so many products that often overlap? Expect to see consolidation in this space. Jawbone, for example, is talked about as a takeout target. 2015 could be the year it gets bought. Second, GoPro goes drone. The consumer drone market is blowing up, and GoPro is taking notice. There are reports that the camera maker will enter the space, and while GoPro isn't confirming these reports, it isn't denying them either. Expect the camera maker to move into drones and drive demand for this hobby even higher. Third, more trouble for tablets. Tablets are under pressure as consumers opt for smartphones with bigger displays and so-called phablets, those phone-tablet hybrids. Expect that pressure to continue in 2015 with the category suffering a slowdown. The exception? Apple's iPads will best expectations as the tech titan stakes out a bigger role in the enterprise space.
The news for banks this year? You're boring. Get used to it. Animal spirits quiet in the face of rigid regulation. With tech companies encroaching on their turf, banks are just trying to protect their core business model, taking deposits and lending money. But 2015 will bring some challenges. First, vocal shareholders. Investors in bank stocks have waited, perhaps too patiently, for rates to rise and business to improve. Banks are seeing scant return on assets and investors scant returns on their investments. Regulation is only making it costlier to be a bank, with doubts now surfacing on whether bigger is in fact better. Expect backlash and more activism on buybacks, dividends, governance, and whether to just break up. Second, mid-cap mergers. Slowly but surely, banks of a certain size are tiptoeing toward deals again. The sweet spot for consolidation? Banks with less than $50 billion in assets. Analysts are watching Comerica, Astoria, and First Niagara Financial. Third, Silicon Valley goes to Washington. Wall Street admits it's losing ground on technology, but says no real threat exists without a government green light. Look for players like PayPal, Google, and Apple to explore a move in that direction.
Still ahead, from the skies to the roads, airlines are coming off a record year and automakers saw a surge in sales. Will the same be true over the coming months? But first, we asked some market pros what they're wishing for in 2015.
My wish for 2015 is that the U.S. economy gets back to full employment so that all those people who want a job get a job, and we see bigger pay increases for everyone else.
My 2015 wish is that we work further and make further progress on peace on earth, goodwill to men. We have a lot of ill will out there. We have a lot of secular kind of things. We have tribal things. We have religious fights. We have battles going on and people being terribly badly hurt. Let's see if we can't build a more peaceful world in 2015.
My 2015 wish for the economy is that Republicans and Democrats come together and initiate an investment program, infrastructure related, capital intensive related. You know, this country needs to invest in things as opposed to invest in consumption.
Well, planes were packed and so were auto dealerships last year. Low fuel prices, rising consumer confidence helped the airlines sell tickets and the automakers sell more cars. So should investors expect more of the same in 15? Phil LeBeau takes a look.
Record auto sales? Probably not in 2015, but the industry should push sales close to or above 17 million vehicles for the first time since 2001. Here are 3 things to expect as sales surge. First, cheap gas. The national average is now well under $3 a gallon, and most analysts believe relatively cheap gas will be with us for much of next year. How low could it go? The Energy Department is predicting a national average of $2.94 a gallon. But even veterans who track gas prices admit it could wind up much lower than that. Low gas prices means you can expect another big year for SUVs. In 2015, SUVs and crossovers will stay red hot, partially because several new utility vehicles will hit showrooms and stir the market. At the same time, fuel efficiency still attracts buyers, even with low prices at the pump, and the newest SUVs are getting better mileage than ever before. Finally, the crossover to watch next year will be Tesla's Model X. The electric crossover with Falcon Wing doors is set to roll out by the middle of next year. Will it be as successful as the Model S? Can Tesla make the transition from cranking out one model to building 2? And will Elon Musk's company attract as many high-end buyers if the world is running on cheaper gas? Talk about soaring higher. Airlines have seen little turbulence while racking up record earnings. In 2015, look for the airlines to stay in the sweet spot for lifting profits and returns for investors. First, low jet fuel costs are here for a while. That will boost profits in the first quarter, when airlines traditionally see their weakest results. But how much of the low fuel cost trade is already built into the recent surge for airline stocks? Another thing you can expect next year? Packed planes. Airlines have been remarkably disciplined not adding too many new flights. They're also cramming more seats into the current planes. JetBlue will continue that trend in 2015. Overall, passengers have grumbled, but they're still flying. But the big change next year will be with frequent flyer programs. It'll be tougher for casual flyers to rack up reward points, but high-end business travelers will love that many airlines, including Delta and United, are moving to programs where frequent flyer miles are awarded based on how much you pay for a ticket. So if you don't fly much, don't expect much in return.
Now to the defense industry, which saw a lot of change in 2014, including the resignation of the man at the top, Chuck Hagel, the Secretary of Defense. So will new leadership shift the industry's focus in 2015? Jane Wells has the defense outlook for the year ahead.
Spending cuts? What spending cuts? Pentagon spending spiked in the third quarter to a 5-year high as the Islamic State became America's latest threat. In 2015, we'll have a Republican-controlled Congress and new defense secretary. Here are 3 predictions. First, hack attack. America runs on the internet, and it seems everyone from China to Syria is hacking into our computer networks. The Pentagon has boosted its cybersecurity spending, but expect more problems than solutions in 2015, more attacks, as defense companies try to figure out what tools are needed and if they even have them. Second, drone wars. In 2015, growth in unmanned aircraft will explode on the commercial side, and established defense players like Boeing, Lockheed, Northrop, and General Atomics will lose ground to a plethora of newcomers like Amazon and Google. Third, substitutes. The Russians recently tested a new missile from a nuclear submarine, but our fleet of subs is old, especially Ohio-class subs, which are supposed to carry most of our deployed nuclear arsenal. The cost to replace them, though, which could benefit Northrop Grumman and General Dynamics, is astronomical. And in 2015, expect the Pentagon to propose paying for them outside the regular Navy budget in a fight over money that could go nuclear.
Coming up, housing and health care are 2 big expenses for many households. So what's in store for both of those sectors in the new year? That's next. But first, we took our cameras out to find out what's at the top of your wish list for 15.
I definitely want to see student loans being improved because I have a lot of loans to pay back. I'm in college, and that's just something that I feel is important.
Of course, I'd like to see much more cooperation between the 2 parties. I'd like to see the Democrats and the Republicans get along together. Otherwise, we're not making any progress.
It's on my wish list. I'd like to see a lot more people have good jobs that they can believe in and depend on and not worry about.
Well, 2014 was a tough year for retailers. Consumers were picky, stores were hacked, and some traditional retailers like Radio Shack and Sears were forced to close locations. So what should investors watch in 2015? Courtney Reagan reports.
Retail saw a lot of changes in 2014, and the headlines won't end when the calendar flips to 2015. Here are 3 predictions for next year. First, Sears stays for now. While Sears won't see a resurgence, it will still be in business in 2015, though 2016 could be a different story. Majority shareholder and CEO Eddie Lampert is undertaking various financial engineering exercises to squeeze out all of the retailer's valuable assets while largely neglecting the retail business itself. It's not a sustainable way to run a business, but Lampert will come out the biggest financial winner in the end anyway. Second, C-suites will stay empty. American Eagle and Abercrombie are among the retailers currently looking for new CEOs. Not only will those jobs stay unfilled for a while, but more vacancies will crop up throughout the year. Online shopping, mobile, and fast fashion have changed how we shop and where we do it. Finding CEO caliber candidates with fresh retail strategies and a knowledge in tech will continue to be a difficult task. Third, the rise of the CMO. As targeted marketing and personalized shopping offers grow in importance, so too will the role of the Chief Marketing Officer. While previously a position that was more of an afterthought, in 2015 the CMO will secure a seat at the head table.
The industry that saw some of the biggest changes in 2014 was healthcare, from mergers in big pharma and biotech to the use of the healthcare insurance exchanges. Will there be even bigger changes ahead? Meg Terrell looks at pharma and biotech. Bertha Coombs tackles healthcare.
Washington will loom large over healthcare in 2015, with Congress and the Supreme Court set to revisit health reform.
Repeal and replace Obamacare? It won't happen.
The Republican majority in Congress will revise parts of the health reform law, likely eliminating the 2.3% tax on medical devices. The employer mandate will stay, but shift to kick in for workers employed 40 hours a week.
The Supreme Court won't undo Obamacare either.
There'll be drama when the justices hear arguments in King versus Burwell, the case challenging Obamacare subsidies on healthcare.gov, because the law's wording specifies tax credits for plans on state exchanges. A ruling against the administration could gut exchange enrollment. Expect Chief Justice John Roberts to find middle ground between the spirit and letter of the law.
In the big push towards consumer-related health care, established players and new entrants are all going to push technology at us,
making 2015 the year of the wearable health gadget. But even Apple's watch will struggle to dominate in a crowded market. Health IT infrastructure players will be the real winners, with increasing demand on data.
If you wanted growth in 2014, you almost had to be in biotech and pharma. Stocks in the sector continued their run, returning more than double the S&P 500. Here are 3 predictions for 2015. First, drug price wars. It may be the biggest threat to biopharma valuations, pressure on escalating drug prices. So far, it's come mostly from health insurers, doctors, and patient advocacy groups. Though in 2015, we could see price wars among drug makers themselves. Specifically, keep an eye on hepatitis C, where Gilead Sciences will face new competition from AbbVie. Second, immunotherapy. It was a hot topic throughout 2014, new cancer drugs that harness the immune system to fight cancer. 2015 will be the year immunotherapy becomes investable in whole new ways. Watch Merck and Bristol Myers for drug launches that could set records, while 2 new companies, Juno and Bellicum, join Novartis and Kite in the race to bring another kind of immunotherapy known as CAR-T to market. Third, drug deals. 2014 was a banner year for M&A in healthcare, though some of the biggest potential deals, mostly driven by tax considerations, fell through. As cash-flush bigger companies continue to look for growth, expect biotechs with promising products, particularly in cancer and rare diseases, to be targets. Analysts are watching companies like Ariad, BioMarin, Puma Biotech, and Medivation.
And finally tonight, the outlook for housing, the biggest expense for many. While home price gains slowed last year across much of the country, mortgage rates stayed near historic lows. Diana Olick looks at the trends to watch in housing in 2015.
The housing recovery took a step backwards in 2014 as home prices rose too far, too fast, and incomes couldn't keep up. Now, as employment improves and price gains ease, 2015 is looking brighter, but perhaps even bumpier, as buyers run head-on into rising rates. Here are 3 predictions. There will be more houses. There have to be. As household formation improves, the builders are looking at more developed lots, easier credit, and a better labor market. I'm going with 740,000 single-family housing starts in 2015 and a little cooling on all that rental apartment construction. Mortgage rates have nowhere to go but up. We predicted rates would rise this year, and we were wrong. But with the Fed pulling away from mortgage buying and an improving U.S. economy, interest rates have to break out of the current lows. It won't happen immediately, but we should see the average rate on the 30-year fixed edging closer to 5% by the end of next year. Home prices have to cool off. Sticker shock sank the market in 2014. Home prices had jumped double digits and payback was well, it wasn't good. Slower sales and more inventory of existing homes added to all those new homes I'm predicting will keep price gains tight. We could even see a few months in the negative, but for the year, a gain nationally of, I'm saying, 2 to 3%.
And that, folks, is Nightly Business Report for the new year. Thanks for joining us. I'm Tyler Mathisen. Happy New Year, everybody, and we will see you right back here tomorrow night. I'm Tyler Mathisen, and this is a Nightly Business Report news brief. Plunging oil and gas prices are always a major business story, but why are oil prices so important to the economy? Well, the general rule is that every $10 drop in the price of a barrel of oil adds a quarter point to U.S. economic growth, and typically lower gas prices are good for the economy because consumers see more disposable income. But falling prices aren't always universally good. One thing economists look at is why are they falling? If it's because demand is lower, that could mean weak growth ahead. Also, over the past 10 years, the oil and gas industry has grown at twice the rate of the overall economy in the U.S., so too much of a fall in prices will be felt there. Be sure to tune in to Nightly Business Report right here on your public television station.